Do markets have you checking your phone way too much? 5Q IQ Financial Power-Ups with Trajan Wealth cuts through that noise. Investing without fear starts now. So welcome to 5Q IQ Financial Power-Ups from Trajan Wealth. I'm your host, Jeff Jr., with my special guests, Marty Bryant and Corbett Leduc. Now, today's focus is investing without fear. We'll tackle numerous items. First and foremost is market worry, Social Security timing, RMD headaches, Social Security taxes, and who in the world is actually taking and putting this all together. If markets keep you up at night, send your questions to trajanwealth.com/5QIQ. So here we go. Have you ever obsessed over checking your performance numbers? We've all been there. So the first question really hits to the heart of that. So what is the biggest financial mistake that you've seen someone make? That's a great question.
That is a great question.
Maybe a couple stories here.
Not contributing to their accounts, whether it's an employer-sponsored account or
Especially if it's matched.
Right. Not getting the free money.
Exactly.
Yeah.
I mean, I think the biggest one I probably saw, I had a guy a couple of years ago, and market crash in 2008, 401k sat in cash from 2008 until 2023.
Wow.
15 years.
Gosh.
And he was just scared beyond belief. And I'm like, and he was getting maybe 0.2% on all that time.
Mm-hmm.
He's like, yeah, I screwed up. I got scared, and that's part of the reason why I'm here.
Well, that's why we have to meet people where they're at. I mean, we can ooh and ah, but it's a no judgment zone. It's where you're at right now. Now we're going to move forward, and this is how we can.
Right. You can't go back in time to fix it. It's water under the bridge, and what are we going to do going forward to get better?
But hopefully he learns from that mistake, though.
He did. We brought him out as a client and all those things. He said, yep, I get it. Now, he felt more comfortable knowing that he had a fiduciary like us watching it and knowing that, hey, yep, you guys are going to have my best interests at heart. I don't really have to worry about it. He goes, I know that I made a mistake, and now I have to make up for it.
Well, and that's an emotional mistake. And I'm not saying you shouldn't be emotional because it's your money, right? But when you make that kind of emotional decision, you're doing yourself a huge disservice. You have got to keep your long-term time horizon in mind.
Right.
Short-term volatility should not dictate, what your future you is going to need.
Oh yeah. But if you have a need for that money in the near term, less than 2 years, less than 3 years, then the reality is you should not be really investing in the stock market. The ability to know that, hey, not all stocks, but at the very maximum that I would feel comfortable with would be like maybe a 60-40 type of model.
Well, see, I'm going to disagree with you there. I mean, that's where our job comes into play. Not 100% of your money needs to go conservative because, we can see just with the inflation that we've had over the last several years. If you go too conservative, you're not keeping up with inflation. You're going broke slowly. You want, interest rates are low, so we're not earning money on our money. So you need to find maybe pull out 2 years worth of expenses into a more balanced type or income producing portfolio, leaving another bucket a little more aggressive to take advantage of what the market has to offer.
Right. But that's the 3 year plus type of bucket.
But
that part of it.
Yeah, but I know you didn't intentionally make a blanket statement like that, but that's what you said. So, we have to go with let's plan for the different phases of when you do need to access money.
Right. Okay. I mean, it sounded like if you have less than 2 years, don't invest in the stock market period. That's what it sounded like. And that isn't accurate.
Yeah.
With the money. Right. With that portion of the money.
Right. With that portion. Right.
Okay. The portion that you might need.
Right.
Okay. I mean, even if you're retiring and you need all of the money, because now it's all retirement money, you still
but you're not
have to be invested in
at
the stock
retirement.
market.
You have to have some bucket that's going to have the ability to outpace inflation.
And is liquid.
Right.
So everything we invest in is 100% liquid in the market.
I mean, the biggest mistakes that happen really have to do with emotions. That's what I've seen.
Emotions.
It's all emotional. They're making very emotional decisions versus logical.
How about taking a loan against their 401k? How do you feel about that?
It depends on the need. You know what I mean?
Yeah,
I mean, it sucks.
Yeah.
Yes, you're paying yourself back. I get that part of it, but still, you're not having the full ability to utilize compounding, compared to maybe like getting a home equity line of credit or something along those lines. And depending upon, how long you are able to pay that back. If it's, $40,000, okay, and you're making $100,000 a year, that's going to be a tough payback within a year.
Yep.
But if you say, hey, I'm going to pay myself back over 4 years or 5 years. Yep. Okay. I have a reasonable payment on it. But the same thing. Now you've taken $40,000 to $50,000 away from the ability to make, say, 12, 14% compared to, okay, I'm going to pay myself back at 5%.
Right. So weigh out your options on where you get the money.
Right.
Right. Don't just rely on that 401k as your emergency go-to. Maybe look to see at a credit union or someplace where you can borrow money and maybe a lower interest rate of what you think you're going to pay yourself back.
People look at debt differently, which is unfortunate.
Right.
Because debt isn't necessarily bad.
No, it's a tool.
As long as it's managed. It's a good tool.
Correct.
It's a good tool.
I mean, look at the big businesses, big companies, NVIDIA, Amazon, Apple, all these growth companies, they borrow money. They bring on debt so that they can continue to produce and grow and hit their revenue projections.
Well, I mean, look at Google. Google, aka Alphabet, just sold a 100-year bond to raise debt. 100 years. If it's at a decent rate, then that makes total sense. But the ability to know that what is that interest rate going to be compared to like a credit card, I'm going to do a cash advance at 28%. Okay, no, that's just dumb. But the ability to know where that money is coming from and how much it's going to cost you. And that's why I tell a lot of pre-retirees, I'm like, look, get a home equity line of credit on your house. Your house may be paid for, but you just never know when you might need $40,000, $50,000 in the future. And if the bulk of your assets are in an IRA account, that's going to be $40,000, $50,000 worth of income. It's great. You're helping out your kids, whatever. But the ability to utilize that HELOC, it's not going to create income. Yeah, there's an interest rate charge on it, but that, say, 8% interest rate charge sure beats the heck out of 32% in taxes.
Well, I'm going to disagree with you on that because I would rather them use a reverse mortgage because they don't have to pay it back. And that line of credit that they're given on the reverse mortgage continues to increase.
But the costs and fees on reverse mortgages are ridiculous.
Not if you don't take any money out.
No, I had one. I climbed through 3 years ago.
There's a closing cost. However, you have to run the math on it.
Wait, this guy got $175,000 and it cost him $22,000. That is ridiculous.
Again, you need to run the numbers because he's still gaining interest. So his line of credit is still growing by that same interest rate.
Speaking of mortgage, one of the dumbest mistakes I think people can make is paying off their house by using money taken out of their 401k.
100%.
Absolutely.
That is so dumb.
Absolutely. And, and people like, Dave Ramsey says, is there a mortgage? Okay, I get that. But if you're going to be, back to the point I said earlier about taking money out of a qualified account, 22%, 32% compared to saying, hey, you know what? I'm going to pay 5% on my mortgage. So, or especially if the rate's super low.
Or if you're
like
at the end of your mortgage. Now you're not even really paying any interest at that point because they're front loaded.
Right.
Now you're getting ready to retire. You're in the principal years of paying it down. Why are you paying taxes on money to pay off an asset that's just cash for you at that point?
And just because your house is paid for, it doesn't mean that, okay, you still got property taxes, you still got homeowner's insurance. So I was like, yay, my house is paid for. But then when they pay it off, they start paying those bills on their own. They're like, oh, wow, I didn't really realize that between my homeowner's insurance and property taxes, I was paying $600 a month. Yeah, if you have a mortgage of, say, $40,000, the interest charges on that is going to be minimal, but, it creates less noise.
But also, money in a house earns nothing.
Nothing.
Right.
So you're taking it from an investment, which is compounding.
Right.
Einstein said the eighth wonder of the world is compounding interest, which it is. Compounding interest will make you rich. Don't take it out of your investments that have compounding interest potential, put it into a house. That house earns nothing.
Right.
Now, some people may be saying, no, that's not true, Jeff. Houses appreciate, which they do. But you don't need to have equity or a paid-off home for it to appreciate.
Right.
It's going to appreciate at the exact same rate if you owe zero or you owe 100% on it.
Yeah, and if you do owe something on it, your ROI is technically better.
And there were people preaching pay off your house when there was 2% loans out there, 3% loans. The bank is giving you money.
Yep.
When you pay off your home, when you have a 2% or a 3% loan, the only one that is making that money back is the bank, and they're laughing. All the way to the bank. So people pay it off.
So you brought up Dave Ramsey. I think he is phenomenal at teaching people how to get out of debt. If you've gotten yourself into debt and it's becoming, very difficult to manage, he has some really great methods of like the snowball method, things like that. Yep. And I'm proud of them. You're out of debt. Now, what do we have saved for retirement? Nothing.
Right.
Because I'm out of debt.
Right.
So what are we going to do now? Are we going to sell your home? Are we going to do a reverse mortgage? How are we going to get you through retirement?
Great topic. Agree 100%. So next we're going to tackle when to claim Social Security so that it actually works with with your investments. Most people know that they should save and invest, but the timing questions here really get tricky. And if you have any questions, don't hesitate to send them to us at trajanwealth.com/5QIQ. Now, one of our listener asks this: when should I take Social Security? We get asked this quite a bit. This is such a good question. So when is the ideal time?
Go to your doctor, find out when you're going to die, and then we'll tell you
If you
when to
knew
take
that,
it.
it would make things a lot easier.
Yeah,
Much
it would,
easier,
yeah.
yeah.
Yeah, unfortunately, people just don't know when they're going to die. So
Yeah.
you can take
Right.
it as early as 62.
Mhm.
And my dad, he was going to retire at 65. So I don't know if I've told you this, but my dad was going to retire at 65. He was in the banking business. And I remember when he was 64, he told me, he said, I'm going to work one more year and I'm working until 65 and then I can get full retirement benefits.
Mhm.
And he died at 64.
Oof.
And the benefit that I received like a $200 death
Funeral,
benefit check
yeah.
in the mail. And
Right.
and that was
Because
it.
you were minor.
Mhm.
Yeah.
So, in this case, it may have been best for him, obviously, to retire at 62 and take it. But that doesn't necessarily work out that way for everybody.
No,
Right.
it doesn't.
What I tell most people, like, look, if you need the money, take it.
Mm-hmm.
If you're still working, then no, do not turn it on.
Don't
because-
just-
Especially
because-
early.
Especially at 62. If
Mhm.
you are planning on working, for majority of people, the full retirement age is age 67. And the way I break it down for most people, look, if you're going to work to 67, no, do not turn it on because you're going to be penalized on the benefits for it, the payment, I should say.
8% per year, permanent reduction in the benefit per year. That
Well,
you
not
take
even
it
that,
early.
but then you lose 30% of that income
Yeah.
for a penalty. The other part that I tell people, like, look, how is the longevity in your family? Yeah, back to your point about the dog.
Yeah.
Nobody knows when you're going to die.
Right.
But if you're in fairly good health, you've got no underlying conditions, from age 62 to age 67, that 5 years is an increase of 40%.
Mhm.
Mm-hmm.
That increase of 40%, your break-even age is about age 81.
Mm-hmm.
So as long as you think you're going to live to be age 81 because you don't have any underlying conditions, diabetes, heart conditions, anything like that, then yeah, pays to wait. But if you need the money and you're short on resources, yeah, you know what? You need it.
Break even is actually 78 in 11 months.
Oh, okay.
So let's talk real quickly about claiming from 62 to full retirement and what that means if they're still working, if they're earning additional income.
Yeah. So earnings restrictions, that means, we used to hear that I'm 62, I need, I'm going to take my benefit now. That's going to get me over the hump. I can pay off debt. But they're still working.
Right.
Mm-hmm.
So once you reach a certain threshold of income, they start reducing your benefit $1 for every $2 earned
50%.
over that benefit. But you don't lose it permanently. Then what they do, what the Social Security Administration does, is they recalculate your benefit once you hit your full retirement age, and we'll just use 67 for the example. So all the money that they withheld, they add that back in, they recalculate, for your life expectancy, the actuarial table calculation, and then they'll bump up your benefit a little bit to offset what they had withheld, putting it back in, and then you'll get that. But it is nowhere near
Right.
making up for that 40% loss
Right.
that you received.
And so if you wait till 67, which is, presumably full retirement here, it varies based upon birth year.
Right.
Yeah.
But if you wait till 67, then you're able to work and not have a reduction in benefit.
That's correct.
Yeah.
Yep.
Yeah.
And the latest you can claim is age
70. Right now.
Mhm.
Right now.
So if you're past 70 and you haven't claimed, you're
Well,
getting money
I think they
tailored.
turn it for you
Oh,
on
they
automatically.
do it
Yeah.
anyway, yeah.
Just like
Yeah.
Medicare. So once you turn 65, they automatically enroll you to Part A for it.
Great
Yeah.
question. So it all depends on your health. It depends on your income need. If you need money, then you don't have a choice. Start claiming at 62. Otherwise, it's generally recommended, especially if you're working, at least go to a full retirement, maybe even to 70 if you have longevity in the family. So let's say you've got Social Security timing figured out. Next up is the RMD puzzle that catches so many people off guard. Can I reduce or avoid RMDs altogether? Good question. Can they?
You can, depending upon timing. So, like we talked in another episode, Roth conversions. Yep. But you're going to have that pain of taxes going up to that. 1, 2, if you do tithe, give charitable deductions, things like that, you can do what's called a qualified charitable distribution. So, for example, if you give $10,000 a year, typically out of cash flow, not the most efficient way to donate that, you could take $10,000 of your RMD, use a QCD, qualified charitable distribution, doesn't count as income at all,
Mm-hmm.
and the ability to know, hey, you know what? If my RMD was $20,000, now it's $10,000 taxable on it. I've done my charitable giving, tithing, whatever you might do, but I've also now cut my RMD amount in half.
It can't come to you first.
Right.
It has to go directly to that charitable
Titled
organization.
to the charity.
Right. And it goes tax-free to them as well. So now in essence, you just took, like, consider it's non-taxable money. It never showed up anywhere to the IRS. No one's paid any taxes on it.
Right.
And you were able, that's much more powerful than taking your RMD, like Corbett said, and then using cash to,
Especially if you don't need
to pay
it,
for
right?
it. Especially if you don't need it.
Especially from our clients that are LDS, and they typically do tithing out of their cash flow. And I educate them on saying, here's a much better way to do it, because at that point, for a lot of people, they're taking the standard deduction. That's it. So that charitable deduction that they give to the church or whatever, all that does is warm their heart. That's it. There's no tax benefit for it compared to, hey, let's take a QCD out of your IRA account when you turn 73 next year. If you typically give, like I said, $10,000 to the church, that's great. But now if you give the $10,000 to the church, to your point, Marty, having the check made payable to them. Now you can have the check come to you, your address, or mailed to them. But it has to be in, the charity, 501c3. Because if you mail it directly to the charity, the problem is they're not going to know from you. So that's why I tell most people, look, have it come to your home address, made payable to the church or Arizona Humane Society, wherever it might be, small plug, and then knowing that, hey, you give that check to them, they're going to know that's from you.
Now, another thing, so we see people working later, right? So let's say that we have somebody who is of RMD age and they're still employed.
Right.
They don't have to take an RMD out of their 401k.
Right.
But out of their IRA, they do.
But out of the IRA, they do.
Yes.
But let's say they have a 401k sitting somewhere else at a different company. So roll that over into your current 401k.
Or you can even take the IRA and roll it into the 401k.
Take the
as
IRA,
well.
roll that into the 401k. Now you don't have to take an RMD anywhere. You're just delaying the inevitable, but
Until you retire.
until you retire, but you're not being forced
Yep.
to take them now.
So really, other than giving it to charity, standard deductions through taxes, there's just no way to avoid RMDs. I mean, I think look at RMDs is the reason you're required to take this distribution out is because you have not been taxed on this money yet.
Right.
The government gave you this benefit to allow you to invest in a pre-tax 401k IRA. So they haven't taxed you yet. Now they're saying we want to tax you before you die.
Yeah.
That's the whole point
exactly.
here. So it behooves you obviously to take this money out. But if you can afford to give it to charity, you don't necessarily need it, or other deductions that you might have in your retirement. That's the way to go about it. So great question. So after the break, we're going to talk about how even Social Security gets taxed and who's supposed to connect all of these moving parts together in the first place. So do you have a coordination question for us? Don't hesitate reaching out at TrajanWealth.com/5QIQ. People think that Social Security is really safe money, but here's the reality check. Is Social Security taxable?
Okay. So with Social Security benefits, when you do start them, most people don't think about the taxation of that benefit that they're receiving.
Right.
And that's why, again, it's important for us to sit down and talk, because if you have taxable, your qualified accounts, you're going to retire, we're going to start giving you a paycheck out of your 401k plan or your money. Maybe we're going to talk about further delaying the Social Security benefit, because now we can satisfy your income needs from what you've saved. We can push off your Social Security benefit to get the delayed credits. And that means now that we're not just going to take in Social Security benefits to have them taxed. So if you have $25,000 or less, none of your benefits are taxable. But then you start getting into this category where maybe 50% of them are taxable,
Right.
up to 85% of your Social Security benefit.
Depending upon your total taxable income.
Right. So
And it's not a
now-
big threshold.
No,
and it's not. It's really not.
It's like $44,600.
For married.
Yeah, for married.
$32,000 for a single.
Yeah.
Yeah. So if we can do that Social Security planning also from a tax standpoint, now we can get you in a better tax picture as well.
And that doesn't mean that it's an 85% tax rate.
No.
It means
Right.
up to 85% of that benefit could be taxed.
Right. And the thing is that to come up with that calculation, they use 50% of your Social Security benefit to go into the amount as they're calculating to see how much is taxable. So the only money that's not included is Roth money. That's the only money. So all the people with the federally tax-free muni bonds, it's all included. Roth benefits are the only ones that are not included
All
in
the
that
more
calculation.
reason to seriously consider if a Roth conversion is.
Correct.
Absolutely.
Right, because
A
then
good
we can
option.
get you in a lower tax
That's
bracket
right. That's
potentially.
right.
Yeah.
Now, final question today gets to the heart of why investing feels so overwhelming in the first place. How can I best coordinate my investments with my estate plan? If you feel like you're juggling advisors instead of building a unified plan, you're asking exactly what we're here to answer. So, how can these people juggle all of this? This is such a softball question for us.
You like softballs. Yes, we've worked together way too long.
Way too long.
So, I mean, yeah, the ability to have all those pieces come together, and especially if you've got different advisors. I know some people are like, oh, I've got my eggs in different baskets and all those different things. Yeah, that's true, but you really have no idea what advisor A is doing compared to advisor B.
Mhm.
And knowing that, okay, you may have huge overlap and not even know it, but you think, oh yeah, I'm doing the right thing because I've got two different advisors. No, you're compounding the problem. And that's one of these two advisors knows, okay, advisor A is doing this, so I'm going to do this differently. But if you're going to do that, then why even have two?
Right.
Have one that you trust completely
Mhm.
and know what it can be.
We keep talking about having the family office here. If our audience has not understood how important it is to have offices communicate with each other, I hope we can really impress that upon them. Because as we're talking about Social Security and Roth conversions and taxes and estate planning and, all of the things that go into all of this,
All under one roof.
and having all of us communicating together is
Right.
of the utmost importance. Otherwise, you're doing yourself a great disservice. You've done the hard work, right? You've made the sacrifices, you've done everything right, and then you go to retire, and there are things that can derail your retirement without you even knowing until you're there, and then it might be too late.
Yeah, for a lot of advisors, they bring them on, all those different things, and then say, yep, hey, I'll touch base within a year. Well,
and
just like with tax planning.
And that's why it's important to work with
Compared
a
to
fiduciary.
our family office setup where we've got the full ability for income planning, investment planning, tax planning, estate planning, all those
Insurance.
different things, insurance,
Mhm.
all underneath one roof, knowing that it's a cohesive, complete wealth management solution
Right.
that almost no one out there can do that like Trajan Wealth can.
Yeah, and I think it is important all under the one roof because it really is about communication. There's a lot of advisors that might give you a referral or an introduction to somebody, but really, what is that? So one thing about our family office is it truly is a family office. We're not referral dependent. We truly do work together.
Right.
Communicate all of your issues with all the different teams. So today we took the fear out of investing, hopefully for you. Market noise we discussed, Social Security timing, RMD traps, taxable benefits, and who's supposed to connect it all. So what investing puzzle still has you puzzled? Well, solve it with us at TrajanWealth.com/5QIQ. And don't hesitate to share this with someone who checks their portfolio way too often. And if they do, don't hesitate to send them our way. We are here to help. Plan smarter, dream bigger. One less thing to worry about today, that is progress. So thanks for joining 5QIQ Financial Power-Ups with Trajan Wealth. I'm Jeff Jr., and we will see you next time.
Trajan Wealth, an SEC-registered investment advisor. Additional services through Trajan Estate and Trajan Tax. Information discussed during this program is intended for illustrative and entertainment purposes and is not investment advice or an offer to buy or sell any investment. Please consult your financial advisor for questions about your financial situation. All investments involve risk and the potential for loss. Any examples given are strictly hypothetical. Your results may vary. Additional disclosures at TrajanWealth.com.